time, and so we came to Los Angeles, and the reason we're doing it from here is because of the man on my left, not because he asked for it, but because all of us wanted to do it with Charlie in here in Los Angeles. So I'll introduce the three vice chairmen of Berkshire in a minute. I'll show you the first quarter earnings. We won't take much time on that. I'll have one or two very short lessons for perhaps the new investors who are not necessarily in Berkshire Hathaway, but people who have entered the stock market in the last year. And I think there have been a record number that have entered the stock market. I'll have a couple of little examples for them, and then we'll swing into a Q&A led by Becky Quick, who's looked at thousands of questions that have been submitted to her. But more can be submitted during this meeting, and we will put up on camera from time to time the way you can communicate directly with her if you want to send questions in during the meeting. She got flooded with them last time, and she miraculously keeps sorting them out. And so feel free to send in a question, and we will have a question period for about 3.5 hours. And then we will finally have the annual meeting, which won't take long at the end. So with that, I would like to first introduce the three vice chairmen of Berkshire Hathaway. I'll tell you just a little bit about them, and then I'll have a mild surprise for you at the end, perhaps. On my left is Charlie Munger, and I met Charlie 62 years ago. He was practicing law in Los Angeles. He was building a house at that time a few miles from here, and 62 years later, he's still living in the same house. Now, that was kind of interesting because I was buying a house just a few months before, 62 years ago, and I'm still living in the same house. So you've got a couple of fairly peculiar guys, just to start with, in terms of their love affair with their homes. And Charlie and I hit it off immediately, and I would say he's probably the vice chairman in charge of culture, among other things. But if I ever want to get questions about where true north is, I talk to Charlie, and he has been an enormous help. He's done it with a lot fewer hours and a lot less talking and everything than I have, but he's contributed in an incredible way to Berkshire. So Charlie's been out here in Los Angeles for 60 plus years. On my right, your left, I have the vice chairman in charge of everything except insurance and investments, Greg Abel. Greg was born and raised in Edmonton, Alberta. He's Canadian, plays hockey. His 8-year-old plays hockey. And he came to the United States sometime after he graduated from college in Canada. And he is in charge of a business which has well over $150 billion in sales and employs more than 250,000, probably 275,000 people, and does a much better job at doing that than I was doing previously. And on my far left, you're right. We have Ajit Jain, and Ajit was born and raised in India, and graduated from college there. And I met Ajit on a Saturday in 1986, and I'd been in the insurance business. Berkshire had been in the insurance business for quite a while. And I was kind of stumbling around in various ways. And Ajit came to the office, and Saturday I was opening the mail. And I said, how much do you know about insurance? And he said, nothing. And I said, well, nobody's perfect, and let's talk about it some. And by the end of the morning, I knew I had somebody that was going to build a great insurance business. And starting from that point, this improbable little company in Omaha became the largest property casualty company in the world in terms of net worth. It writes risks occasionally in a 24-hour period that other companies simply couldn't take on themselves. They'd have to assemble other people. It would take them a long time to come to a decision. That was very important at various times in the past. It's not so important now. But he's built an incredible, the world's leading property casualty insurance company. So here we have Charlie from L.A., 60-some years. We've got Greg from Canada. We've got Ajit from India. And the one thing in common that these three fellows have, aside from working for Berkshire and doing a sensational job, the one thing in common is that at one time or another, for some extended period, they lived within a mile of me in Omaha, Nebraska. And Charlie in 1934 moved about 100 yards away from where I now live and went through high school, eventually went into the service, and knows the neighborhood as well as I do. Went to the same grade school my kids went to and so on. Greg spent significant time living in Omaha, lived about 5 or 6 blocks from me, and now lives in Des Moines. And Ajit was in Omaha, about a mile away for a couple of years. So we started in very different places and sort of came together and now go our separate ways, but it's all worked very well. I would, and you'll hear from them during this meeting, I urge you to send questions if you're thinking you can direct them to me or you can direct them to any one of the other three, and it will be a big relief to me if you direct a fair number to the other people. So we, this morning, as we always do it on Saturday, we published our 10Q, which gave the quarterly earnings. It's up on our website, berkshirehathaway.com. And it's very interesting. We put these out on Saturday morning. That's not because the media likes us to do it that way. It's not because the analysts like to do it that way. But we want to give you the maximum time to digest an awful lot of information that's in that 10Q. It can't be summarized in a perfect way. We'll give you some summary figures, but if you're really a student of the place, and most of our investors buy because they simply have faith in these other three fellows to do a good job, and it's not a misplaced faith. But if you really enjoy going into the details and you want to understand the nuts and bolts of Berkshire Hathaway's various operations, you should read that 10Q, and it'll take you. It may take you a couple of hours. I mean, it's not a small investment of time, but it's got a lot of information about all our various businesses. And for those of you who are business students of a sort, I recommend you go to it. The summary figures you see here, which are the ones we put in our press release, show kind of an interesting pair of numbers. I made it down there at the bottom. We have last year, when you see those brackets around numbers, you got to start worrying. And first quarter, we actually showed a loss of almost $50 billion. I never thought I'd ever see a figure like that. And I was thinking back, I was trying to remember whether I'd gone on vacation during that quarter and turned things over to the other guys or what. But I checked the calendar, and that was me. That figure this year is a positive figure of 11.7 billion. And neither figure is very meaningful in itself. The Accounting Standards Board a few years ago, for many years, unrealized gains or losses of a company like Berkshire were made adjustments to the net worth of Berkshire, but they did not run through earnings. And a few years ago, the rule was changed so that every time the stocks go up or down, it goes through our earnings account. So in the first quarter of last year, when stocks went down a lot, we had a huge sum of unrealized. Well, it was a reduction of unrealized gains largely. And when you start saying things like that, you start losing people. But that item was a mild plus this year. But if we reported earnings daily, you would see earnings one day of $3 billion, next day of minus $2 billion, and it's an accounting treatment that we don't think is particularly appropriate, but it's required, and we explain very carefully, both in our press releases that we try to explain, and I try to write in my letter and explain why I don't think that's the way to look at Berkshire. We think over time that we will have investment gains for reasons I lay out in my letter. Over a period of time, the companies we own stock in retain earnings, and they use those reinvested earnings usually to our benefit, and that shows up in capital gains someday. But reported earnings for a company that has a lot of common stocks, marketable stocks like ours, you don't want to look at that final line, and you do want to look at the operating earnings line. Now, I would say that if you had taken the first 2 months of last year and compared to the first 2 months of this year, those figures would have been quite comparable. But of course, in March of 2020, the economy was shut down. In effect, I mean, it was a self-induced recession, and an abrupt one, very abrupt. And so the economy went off a cliff in March. It was resurrected in an extraordinarily effective way by Federal Reserve action and later on the fiscal front by Congress, and we'll get into that later. But the figure you see that the difference was March, basically, the two. And our businesses have done, we'll get into more specifics later, but our business has done really quite well. This has been a very unusual recession in that it's been localized as to industry to an extraordinary extent. And right now, business is really very good in a great many segments of the economy, which we'll talk about later. But there's still problems if you're in the few types of business that have really been decimated, such as international air travel or something of the sort. So with that, we'll go back to the figures later on, perhaps in some of the questions. I would like to just go over two items that I would like, particularly new entrants to the stock market, to ponder just a bit before they try and do 30 or 40 trades a day in order to profit from what looks like a very easy game. So I would like to go to slide L1. So put that up. After the Constitution, 232 years later, leaves us with 5 of the top six companies in the world. It's not an accident. And it's not because we were way smarter, way stronger, anything of the sort. We had good soil, had decent climate. But so some of those other countries I named. And the system has worked unbelievably well. Just imagine thinking of 5 of the top 6 companies in the world ending up with a country that started with 0.5% of the population just a few hundred years ago. But what I would like you to do is look at that list for a minute or two, if you want to, and then make an estimate which goes back a little more than 30 years, and look at the top 20 from 1989. And if you look at the top 20 from 1989, there's 2 things that should grab your interest, at least 2. None of the 20 from 30 years ago are on the present list. None. 0. There were then 6 U.S. companies on the list, and their names are familiar to you. We have General Electric, we have Exxon, we have IBM Corp. I mean, they're still around. Merck is down there at number. None made it to the list 30 years later, 0. And I would guess that very few of you, when I asked you to play the quiz a few minutes ago, would have put down 0. And I don't think it will be 0. But it is a reminder of what extraordinary things can happen, things that seem obvious to you. Japan had this wonderful bull market for a very long time, so you had a number of Japanese companies on the list. Today there are none. And the United States had the 6. Now we have 13. But they aren't the same 6. I would invite you to think about one other thing as you look at this list. 1989 was not the Dark Ages. I mean, we weren't just discovering capitalism or anything else. And people thought they knew a lot about the stock market, and the efficient market theory was in, and it was not a backward time. And if you look, the top company at that time had a market value of $100 billion, $104 billion. So the largest company in the world, title, in just a shade over 30 years, has gone from $100 billion to $2 trillion. At the bottom, the number 20 has gone from $34 billion to something a little over 10 times that. Well, that tells you something about what's happened with equality, which is a hot subject in this country. It tells you a little bit about inflation, but this was not a highly inflationary period as a whole. But it tells you that capitalism has worked incredibly well, especially for the capitalists. And it's a pretty astounding number. Do you think it could be repeated now that 30 years from now that you could take $2 trillion for Apple and multiply any company and come up with 30 times that for the leader? It seems impossible, and maybe it is impossible. But we were just as sure of ourselves as investors and Wall Street was in 1989 as we are today. But the world can change in very, very dramatic ways. And I'll just give you one other example you might ponder. This is when you start feeling too sure of yourself. One thing it shows, incidentally, is that it's a great argument for index funds, is that the main thing to do is to be aboard the ship, a ship. They were all going to a better promised land. You just didn't know which one was the one they'd necessarily get on. But you couldn't help but do well if you just had a diversified group of equities. U.S. equities would be my preference, but to hold over a 30-year period. But if you thought you knew a lot about which ones to pick, or the person that you had hiring, you were paying a lot of money to, had all these ideas, and it could tell you their best ideas in 1989 did not necessarily do that well, although overall equities were absolutely the place to be. Secondly, people get enormously attracted to various industries. I mean, they think if you know, if a company says it's in the XYZ industry and that's a popular one, you can sell IPOs, you can sell SPACs, people disregard sales numbers, earnings numbers. It's just, it's the place to be. So, Berkshire Hathaway, where was the place to be in 1903 when my dad was born in 1903, but that wasn't really that big of news. But and it wasn't big news that actually Henry Ford was starting the Ford Motor Company. He'd failed a couple of times before, but he was about to change the world. I mean, the auto, when you think about everything, we've got a great auto insurance company. If there weren't any autos, we wouldn't have Geico. But it transformed the country. And Henry Ford brought in the $5 daily wage, and that was a huge thing. Assembly lines, everything, autos came along. So let's just assume that you had seen a quick glance back in 1903 of all the interstate highways, 290 million vehicles on the road in the United States, everything about it. And you say, well, this is pretty easy. It's going to be cars. It's going to be autos. Well, Berkshire, let's see what we've got up there. Yeah, no, say where you were. Go back. I don't want to change slides yet. Go back to the L's. The Berkshire, by accident, well, we own a company called Marmon. We bought it from the Pritzker family some years ago. The Pritzkers had built this business from many, many, many companies that they'd acquired. And the name of their company was Marmon. And I don't know exactly why Jay and Bob decided to name it Marmon, but they did own a company called Marmon. And the Marmon company getting slightly ahead of me on the slides again, but that's okay. We called it. They owned this company Marmon, which in 1911 had been the company whose car won the first Indianapolis 500. Maybe that's why they called it Marmon. They were proud of the fact that the company in 1911 won the first Indianapolis 500. It also was the company that invented the rearview mirror. I'm not sure whether that was a big contribution to society, and certainly around your household. Rearview mirror, you don't want to emphasize too much, but they the car that was entered in the Indianapolis 500, the guy who normally sat next to the driver and looked backwards to tell what the competitors were doing, he was sick, so they invented the rearview mirror. So let's just assume that you decided that autos were this incredible thing, and someday there'd be an Indianapolis 500, and someday they'd have rearview mirrors on cars, and someday 290 million cars would be buzzing around the United States, or autos, or on the county trucks there. And so I decided to look at the history, and I thought I'd put up the list of auto companies from over the years. And I was originally going to put up just the ones that were the M's so I could get them on one slide. But when I went to the M's, it went on and on and on. So I just decided to put up the ones that started with M-A. And as you can see, there were almost 40 companies that went into the auto business, just starting with M-A, including our Marmon there in the middle column, and which lasted for quite a while. It was selling cars in the 1930s were really quite special. But in any event, there were at least 2,000 companies that entered the auto business because it clearly had this incredible future. And of course, you remember that in 2009, there were 3 left, 2 of which went bankrupt. So there is a lot more to picking stocks than figuring out what's going to be a wonderful industry in the future. The Maytag company put out a car. Allstate put out a car. DuPont put out a car. I mean, there was a Nebraska Motor Company. Everybody started car companies, just like everybody's starting something now that can be where you can get money from people. But there were very, very, very few people that picked the winner or got the opportunity. At Ford Motor, Henry Ford had a few partners, and he really didn't like them, so he figured a way to buy them out. That was sort of the it was sort of the beginning of the auto finance. That's a long story. We won't get into that. But you couldn't buy into Ford Motor, and of course General Motors became the dominant company. Finally, when Henry Ford did not really make the shift from the Model T to the Model A, it did not work very well. So I just want to tell you, it's not as easy as it sounds. And with that, we will go to Becky Quick, and she will ask any of the 4 of us questions she has selected and which she doesn't share with us. And we will do this for a considerable period of time. You can be sending in questions to her, and then later on, after about 3.5 hours, we will have the annual meeting, which won't take long. So, Becky, over to you.
Thanks, Warren, and hello to everybody. This first question that came in from Andy Sees. He says he's the owner of not nearly enough B shares. He says, Mr. Buffett, you're well known for saying to be fearful when others are greedy and be greedy when others are fearful. But by all appearances, Berkshire was fearful when others were most fearful in the early months of COVID. Dumping airline stocks at or near the low, not taking advantage of the fear gripping the market to buy shares of public companies at exceptional discounts, and being hesitant to buy back significant amounts of Berkshire stock at very attractive prices. I'd appreciate hearing your thoughts surrounding this time and how Berkshire approached its decision-making, specifically after it was assured through the CARES Act that the government would provide a robust backstop to the financial markets.
Well, of course, until both monetary and fiscal policy kicked in, you knew we had an incredible problem. And I am, just as Charlie is the chief culture officer, I'm the chief risk officer of Berkshire. That's my job. We hope we do well, but we want to be sure we don't do terribly. But we didn't sell a substantial amount. I mean, we're a company with probably $700 billion worth of businesses. Some we own in their entirety, some we own a piece of, and I don't know whether we were sellers of maybe 1% of the value of all the businesses we had at that period. But the airline, it's kind of interesting with the airline businesses in particular, and then I'll get to what was done in fiscal and monetary policy. But we had a few people, various subsidiaries of Berkshire, that wanted to go in for help from the government, and in some cases they had minority shareholders owned a few percent, and they said, "Well, this, we're going to get killed by what's happening with the regulations that are being put out, and we're stopping the economy." And they said, "Everybody's going in for them, and why don't we go in?" I said, Berkshire can handle it. This is for people that can't handle what's happening, and so we're not applying. But the airlines were the most prominent beneficiaries of what took place immediately. They got $25 billion initially, most of which went to the big 4 airlines, and some of which went in as grants, not loans. I think that was fine public policy. I wish it could go to every restaurant and dry cleaner and every small business that really was out of business and had no. I mean, they were made toast of, basically. But the airlines, clearly, what happened was not their fault in any way, shape, or form. It wasn't like 2008 and 9 when people blamed the banks and hated to see them help. So it was. Now airlines operate in bankruptcy, so it isn't like the 3 of the 4 big ones went through bankruptcy within the previous 10 So the airlines that were kind of used to operating in bankruptcy, they would have kept operating, but it was perfectly proper for the airlines to be helped. The entire airline business, you look at these figures of $2 trillion for Apple and so on. The entire big 4 airlines, they sold for about $100 billion almost. I mean, it's a very, very small. Combined, they wouldn't come close to making the cut. I mean, they wouldn't be in the top 50. So anyway, they went into the government. They needed government help, or they would go bankrupt, some of them, and really the Congress, but Steve Mnuchin too. They decided they deserved the help, which I do not quarrel with at all. But imagine if Berkshire was the 10% holder, which they had been, of everyone in the airlines. They said, take it from Berkshire. I mean, it'd be like one of our. They might have very well had a very, very, very different result if they'd had a very, very, very rich shareholder that owned 8 or 9%. And they didn't have that, when they went in. So you might not have gotten the same result. In fact, I would think you probably wouldn't. I mean, I can just see the headlines now. I mean, because you've seen the headlines on some companies that took $100 million or $2, and really didn't need it, and some of them gave it back, and most of them gave it back. But you're actually looking at probably at a different result than if we'd kept our stock. But in any event, an industry that was really selling for less than $100 billion lost significant amount of money. They lost prospective earning power. I mean, right now, international travel's not come back. But I would say overall, too, the economic recovery has gone far better than you could say with any assurance. So we didn't like having as much money as we had in banks at that time. So I cut back some of the bank investment. But basically, our net sales were about 1% or 1.5%. And looking back, it'd have been better to be buying. But I do not consider it. I do not consider it a great moment in Berkshire's history. But I also don't. We've got more net worth than any company in the United States under accounting principles, and we've got 600 or 700 billion of generally good businesses, and I think the airline business has done better because we've sold, and I wish them well. But I still wouldn't want to buy the airline business. International people really want to travel for personal reasons, and business travel is another thing. And we've got a big exposure to business travel, of course, through the fact that we own 19% of American Express, and we own Precision Castparts, which services our business very dependent. So we've still got a big investment in air travel, a big commitment to it. But we wish the Big Four the best, and I think their managements have done a very good job during this period.
More specifically beyond the airlines, though, just the idea, and this came from several questions, too, including one from Chris Blaine, just you spent years accumulating cash, insisting you had your elephant gun ready. The March 2020 listed equity sell-off came with promises from the U.S. government that they would do what it takes, yet you sat on your hands. Please help me understand what I missed.
I didn't get quite the last part. What was the final question?
Just please help me understand what I missed. Why didn't you use more of the cash at hand?
Oh, well, we have about, our cash on hand has been about 15% of our values of our businesses, and that's a healthy chunk. And I'd say it'll never get below 20 billion, but we're going to raise that number because it's just the size and importance of Berkshire. But we could have deployed 50 or 75 billion. And right before the Fed acted, I mean, we hit a point where the calls were, 2 calls came in. But there was 2 or 3 days, nothing could happen. I mean, when Jay Powell acted as he did, that was incredibly important. I mean, I should say the Fed acted as they did, but they moved with speed and a decisiveness on March 23rd that changed the situation where the economy had stopped. The government bond market was even disrupted. Berkshire Hathaway probably could not have gone out with a debt offering the day before. There was it didn't get a lot of publicity time, but there was a run on money market funds, a very substantial run. And if you look at the numbers, daily numbers on that, it was a repeat of September 2008. And this time, I give great credit to what Bernanke and Paulson did, but this time, the Fed knew that saying whatever it takes and saying it and demonstrating it, which they did on March 23rd, they took a market where Berkshire couldn't sell bonds on the day before and turned it into one where Carnival Cruise Lines or something could sell it a day or two later. And there was, it's record issuance of corporate debt and companies losing money, companies that were closed, whatever. It was the most dramatic move that you can imagine. And at the time, as I remember the chairman saying, how about a little help on the fiscal front? And then Congress acted very, very big. Again, in 2008 and 9, they argued about, we don't want to give money to those dirty banks and all that sort of thing. But this time, there really wasn't anybody to blame. So they saw what was necessary, and Congress responded. So you had fiscal and monetary policy that responded in a way that was incredible, and it did the job. And I think it did a better job than either the Fed or the Treasury or anybody expected. I mean, this economy right now is 85% of it is running in super high gear, and people can't, and you're seeing some inflation and all of that. It's responded in an incredible way, and we learned something out of 2008 and 9, and then we applied it. But I don't think it was a sure thing that would happen. And the one thing about Berkshire is we don't want to depend on anybody. We're not a bank. We can't go to the Federal Reserve if we need money, and we've got to be sure that under any circumstances, we can't solve nuclear war, and maybe we can't, but. Blanche Dubois, if you remember, in the Streetcar Named Desire, said, I depend on the kindness of strangers. You can't depend on the kindness of your friends if things really stop. I mean, I've seen that in several different places. And we were seeing it on the middle of March. Everybody was drawing down the credit lines. The banks did not expect that. They just weren't sure they were going to be able to draw down their credit lines 10 days later. And so they just drew them down, and they took the money out of money market funds. We got very prompt. I give great credit on both the monetary and fiscal side of what was done, but I didn't think it was a sure thing that would happen, and I didn't know how it would be implemented. And it's worked. I think it's worked better than just about anybody has expected. And I think, well, you're seeing it now. Charlie's got some views on this too, so we shouldn't leave him out of it.
Well, it's crazy to think anybody's going to be smart enough to husband money and then just come out on the bottom tick in some crazy crisis and spend it all. There always is some person that does that by accident. But that's too tough a standard. Anybody expects that of Berkshire Hathaway is out of his mind.
Yeah, Charlie and I never were very good at dancing, but we really can't do that dance.
No, we can't. And that, by the way, almost nobody else can either.
Not with tens of billions or hundreds of billions. But it's worked out. Well, we forgot to show one of the financial sides, actually, if you go back to the balance sheet. But we did buy in the first. You'll see the shares outstanding if we go back to what is it, E3?
E2. You look
slide.
E2.
Pardon me?
I think it's E2. Is it?
Well, the balance sheet. Yeah, there it shows the shares outstanding at the bottom, and we spent about $25 billion in the first quarter and more money since, and it's the best thing. We can't buy companies as cheap as we can buy our own, and we can't buy stocks as cheap as we can buy our own. So, and we've been able to do that with a fair amount of money. But looking back, I mean, if you, definitely we could have done better things. we would have sold airlines and cut back on banks regardless. Whether we should have bought something else at the same time is another question.
This question comes from a long-term shareholder who's been here for more than 25 years. His name's Ben Knoll. He's from Minneapolis, Minnesota. And he says, Mr. Munger and Mr. Buffett, after a 15-year period of market underperformance, you're cautious about predicting Berkshire being able to outperform the market in the future. Given this, what do you see as the arguments for longtime shareholders to continue holding their stock versus diversifying their risk across an index?
Charlie, you want to answer that?
Well, sure. Well, I personally prefer holding Berkshire to holding the market. So I'm quite comfortable holding Berkshire. I think our businesses are better than the average in the market.
Is it because you don't think the market values it fairly?
Well, these are just accidents of history, and things are fluctuating at all times. But on a composite basis, I'd bet on Berkshire over the market. That's assuming we're all dead.
I recommend it. I recommend the S&P 500 index fund, and have for a long, long time to people. And I've never recommended Berkshire to anybody because I don't want people to buy it because they think I'm tipping them into some side. Never. I mean, no matter what it was selling for. And I've made it public. On my death, there's a fund for my then widow, and 90% will go into an S&P 500 index fund, and 10% of Treasury bills. On the other hand, I'm very happy having my future contributions to a group of charities that'll be spread over 12 years or so after my death to stay in Berkshire. I think the odds are Berkshire is, I like it, but I'm not. I do not think the average person can pick stocks. We happen to have a large group of people that didn't pick stocks, but they picked Charlie and me to manage money for them 50 or 60 years ago, and so we have a very unusual group of shareholders, I think, who look at Berkshire as a lifetime savings vehicle, and one they don't have to think about, and one that they'll look, if they don't look at it again for 10 or 20 years, that will have taken care of the money reasonably well. But that, I wouldn't argue that the S&P 500 over time. I like Berkshire, but I think that a person who doesn't know anything about stocks at all and doesn't have any special feelings about Berkshire, I think they ought to buy the S&P 500 index.
As a follow-up to that, Gerald Silver writes in, he says, the trustees of your estate I believe you've directed the trustees of your estate to invest substantial assets into the index fund. Isn't that a vote of no confidence to your managers?
Well, no, because we're talking about way less than 1% of my estate. And one thing I'm going to do, incidentally, all rich people get advised by their lawyers, set up trusts so that nobody can see your will and all that sort of thing. My will is going to be public record, and you'll be able to check at some point when I'm telling you the truth about what is going to get done. But 99.7% roughly of my estate will either go to philanthropies or to the federal government, and before it does it, I think Berkshire is a very good thing to hold. But for a given individual, particularly my wife, I just think that having a tiny fraction, which is all it takes for her to do very well for the rest of her life, I think that the best thing to do is buy 90% in an S&P 500 index fund. Now, the index fund people naturally have started over the time. They market more and more products that go to other indices and everything. So they're really starting to say to the American public, they're saying, well, you can pick what continent to invest in, or you can pick what industry, and we'll sell you something for that. And when they just have gotten through telling them, you really don't know anything about stocks, and just buy the whole index. So, so I named the 500 index as one, but it's a tiny portion, but it'll be her livelihood, and she'll have all the money she needs and way beyond it, and that's that. But I don't mind having the 99.7%. Large portion of it, assuming that laws are the same as now, go to philanthropy, to be kept in Berkshire until they finally are disposed of.
This question comes from Andrew Dixon in the UK. He says, my question is in relation to the oil and gas business and your purchase of Chevron stock. When being asked a question on tobacco stocks in 1997, you mentioned that individuals and companies occasionally have to draw moral lines about what they're willing to do. You stated at the time that you were not comfortable in making a big commitment in tobacco stocks and that you were uncomfortable about their prospects. Charlie has also referenced passing up on a private tobacco deal that you both knew was a cinch, yet you both have no regrets in saying no to the transaction. I'm not suggesting that the oil and gas business has the same known negative externalities as cigarettes. They do not. With tobacco, the cause and effect relationship between the products and cancer is direct, obvious, and measurable. With hydrocarbons, the societal costs and benefits are far more complex to evaluate. However, an increasing portion of society is drawing their lines in such a way that their painting does not include hydrocarbons, period. My question is, has the alarmism from the climate community now become pervasive across society to the extent it has become irrational? Have we built our own unrealistic consensus on the pace of change achievable with regards to the transition to greener energy sources to the extent that this is becoming an overly expensive tax worn by the current younger generation? Can we gather from your purchase of Chevron stock that you do not believe the howling from society, regulators, and politicians will impair the prospects of hydrocarbons, and Chevron for that matter, in the next 10 years? Can investors still assume an oil and gas business that finds and produces oil at low cost per barrel can generate a sufficient return on capital for a long time to come?
Well, I'll give you a 10-word answer to that. I can't remember all the questions that were there, but I would say that people that are on the extremes of both sides are a little nuts. I would hate to have all hydrocarbons banned in 3 years, or you wouldn't want a world, it wouldn't work. And on the other hand, what's happening will be adapted to over time, just as we've adapted to all kinds of things. I do not think, I'm interested in that quote from 1997, because we've talked about this before. We have no problem owning Costco or Walmart, and a substantial number of their stores, and they sell cigarettes. It's a big item. It's something that brings people in. They know the price of cigarettes, and they put them up front. And so we don't. It's a very tough situation. We made that decision a long time ago when we went to Memphis, and we looked at a business that was a very, very good business, and it was much less harmful, at least from everything I could find out. It was much less harmful than smoking tobacco, chewing tobacco was. And these were decent people, and they were running a legal business, and they all chewed tobacco themselves. So they told me that their mother was 100 and chewing tobacco and all these things. But Charlie and I did go down in the lobby of that hotel, and we just said to ourselves, this is probably the best business we've ever seen. And I called my then son-in-law, Alan Greenberg, and he'd studied chewing tobacco and its effects when he was working for a native-related organization, and we decided not to do it. But would we? I used to see ads in our paper from financial companies where I knew they were terrible. And it's a very tough thing to decide whether you get in or out of a business. It's a very tough time to decide what companies benefit society more than others. I mean, I don't know whether I think Chevron's benefited society in all kinds of ways, and I think it continues to do so. And I think we're going to need a lot of hydrocarbons for a long time, and we'll be very glad we've got them. But I do think that the world's moving away from them too, and that could change. I don't like making the moral judgments on stocks in terms of actually running the businesses, but there's something about every business that if you knew what you wouldn't like, you know, meat packers or anything. Have you ever gone through a meat packing? You know, if you expect perfection, you know, in your spouse or in your friends or in companies, you're not going to find it. And what you elect to do yourself, if you own an index fund, you're going to own Chevron. And believe me, Chevron is not an evil company in the least. and I have no compunction about owning, in the least, about owning Chevron. And if we owned the entire business, I would not feel uncomfortable about being in that business. Charlie?
Well, I agree. You know, you can imagine two things. A young man marries into your family. He's a English professor at, say, Swarthmore, or he works for Chevron. Which would you pick? Because I don't see. I want to admit I'd take the guy from Chevron.
Well, I hope your daughters agree with you.
On the other side of that argument, because there were lots of emails that came in on both sides of these ESG questions. This one comes from Christina Gallegos, who's been a shareholder since 2018, and she says, on items 2 and 3 of the proxy materials, the board recommended voting against on the shareholder proposal regarding the reporting of climate-related risks and opportunities, as well as on the shareholder proposal regarding diversity and inclusion reporting. Berkshire is such a force for good when it comes to financial literacy and empowerment through wealth creation. Why not be a force for good and an example when it comes to these two very important issues? Please share with us more about the against recommendation.
Well, I think maybe Greg can talk a little bit about what Berkshire has done as opposed to in terms of the environmental. I would say this: it's very interesting. With everything that's being, I think we have over 1 million shareholders. I mean, you can't be 100% sure because of street name and duplicate accounts and all that sort of thing, but it certainly seems very, very likely. I've had, and I get the letters that are written to me. I don't think I've had 3 letters in the last year or anything from shareholders. Now I have them, and our vote on this, as you'll see later, is that overwhelmingly the people that bought Berkshire with their own money voted against those propositions. Most of the votes for it came from people who've never put a dime of their own money into Berkshire, and so they and I don't think they've read our annual reports, and I don't think they've read the reports of Berkshire Hathaway Energy, and I don't think they know. You know, if I talk about what we're doing in high voltage transmission, we're doing more than any company in the country. The president talked about what the government's going to do and how important it is, and you know, we have a record that's overall is incredibly good, but we have a group of organizations just generally, and they're nice people, but they want us to answer a bunch of questionnaires their way, so they want us to go to Dairy Queen and Borsheim's and all those people, have them fill out reports that show a bunch of figures when the reports that count are the reports that Greg gets on Berkshire Hathaway Energy and the railroad. And you talk about 3 of our companies and you've covered 95% of it. And it's asinine, frankly, in my view. Now, we do some other asinine things because we're required to do them, so we'll do whatever's required. But to have the people at, you know, Business Wire, you know, Dairy Queen, all these places, filling out reports to make it some common report that comes in. We don't do that stuff at Berkshire. We've got, during the pandemic, we probably have about 12 people to come into headquarters, and we've got 360,000 people working in a company that all kinds of diverse activities, and it's built. I don't want to get into the whole thing. It's built on autonomy, and I am probably the only CEO of an S&P 500 company that does not get a consolidated income statement every month. I mean, every other company, I'll bet in the S&P 500, prints out the earnings they had at the end, from February and March, and the CEO gets, and a whole bunch of other people get it. I don't get it. I don't need it. And I could put 60 or 70 companies in a whole lot of trouble and everything, and they'd hand me something and I know the answer to it already, and it doesn't make any difference. I mean, they've got the money they need. So we don't do things just because we've got a department of this or a department of that, and we don't want to set up a lot of departments like that. And what's important is what we're doing in primarily at Berkshire Hathaway Energy and the railroad. I mean, that's and I'll let Greg tell you about that in just 1 second. But
Warren, I don't think we know the answer to all these questions about global warming and so forth. And the people who ask the questions think they know the answers. We're just more modest.
Well, but even if we knew the answer, I mean, in terms of the reports we would not collect a whole lot of things that don't mean anything to us, and to satisfy people who actually don't own any stock themselves, and in many cases I can tell they haven't read our annual report even. We, as I pointed out in the annual report, and nobody would have guessed this. People think we're a bunch of guys that own stocks and all that sort of thing. Berkshire Hathaway owns, by GAAP accounting, more property, plant, equipment, business infrastructure, which the president just got through talking about Wednesday night in infrastructure, the importance of it. We have, measured by GAAP accounting,